Hi, everyone. Welcome to another BI show. Today, we are going to review the latest BI article and the general ideas that we have discussed this week. This week, we had a slight difference because we had a lot of macro discussion. So we published that piece first. And right after we record this video, we will publish the on-chain piece, which will also have a little bit of a macro update, but focused on chain, and publish them together. So by the time you are watching this video, you will have access to the article as well. This week is going to be slightly different than previous weeks. Just as a reference, today's Wednesday, June 11th. We're recording at 4 p.m. Eastern Time. Z and I are back again to review what's happening in Bitcoin and provide a detailed discussion for our premium members. So these videos, as you know, are premium only. Sometimes a summary or a first part of them will be available on YouTube. So if you're watching this on YouTube, you will only be able to see the first part, and the second part will be accessible to our premium users. If you want to explore our products, just go on this link, 20versecapital.com/BI, and join our team, join our family to benefit from the very frequent, detailed, and accurate reports of the BI team. All right, so with that, let's dive into it. I have a quick discussion on the macro piece, macro focused piece that we published on June 9th, 2 days ago. Again, the difference was that this is now fully focused on macro and money, and then the upcoming issue of this week will focus on chain. The reason we did this is that there is a massive signal we observe in the macro world for the second half of the year. You know, the first half was a lot of negative things. After Trump came to office, he basically brought the protectionist with him. Capitalists got a back seat, and a lot of bad things for the markets were happening at the same time. Lots of uncertainty, trade wars, spending cuts, and all that. So most of our effort in Bitcoin intelligence has been to guide our audience and our readers through this volatility. So we are past that, and I think we did a really, really good job guiding people on how to navigate and understand what's going on. We had our famous V-shaped recovery playbook, and this is now over. We've got our V-shaped recovery. Now we have to focus on what's coming, and that's why we are really excited about this new issue, which she talks about what's coming in the second half. And what's coming is going to be a lot of liquidity, a lot of pump, which coincidentally exactly aligns with what you would have expected from prior Bitcoin cycles, for us to peak in the second half of the year. For whatever reason, macro is also aligning with that. Now, Trump is introducing this bill that adds about $3 trillion to the deficit. This is the same Trump that was scaring everyone into, hey, we're going to bring Doge. Doge was promising $2 trillion a cut, which became a few hundred billions, and then now less than 10 billion, I think, is proposed, and we'll see by the end of it how much is actually cut. So it ended up being a nothing burger, and it's actually in reverse and in acceleration mode. We are going to add a lot of deficit. We are going to add a lot of government spending, which will have a lot of negative effects. That's probably the main reason a lot of people are in Bitcoin, because government spends unlimited amounts of money, which causes inefficiency in the economy, and it's unfair, it's corrupt, and leads to more inequality. So we titled this report, The Big Beautiful Devaluation. The idea here is that dollar will be devalued massively. And with that, a lot of financial assets will be pumped. A couple of highlights from this report was that there is a new fiscal narrative in town. Again, in the first half of the year, the narrative was we're going to cut spending. Deficit is really bad, and we are worried about our future children, and the government is going to be bankrupt, so we have to reduce our debt and spending and trade deficit and fiscal deficit and all that. And pretty much all of that is going out of the window. Now, the recent commentary from the Trump officials is that we're now, instead of cutting spending, we are going to grow our way out of our debt. Grow our way out is basically has two meanings. Growth could be nominal, right, or it could be real. And one point we mentioned in this report is that the real growth, to grow out of your debt, is going to be impossible. It's probably something like 20% growth for 10 years, which is very, very much unlikely. So instead, the only other solution here is inflation. So the goal would be to devalue the dollar so they can pay back the bonds with devalued dollars, which is essentially a soft default. Now, the way you want to protect yourself is to own anything that's a hard asset. Gold, and much more effective would be Bitcoin. In this report, basically we mentioned that a major liquidity wave is about to be unleashed in the second half. The big beautiful bill, which is going to add to the deficit, that's coming. The narrative is coming with it that spending is not fashionable. Spending cuts are not fashionable anymore. So it's all about more growth. The way the government will stimulate more growth is going to be through all sorts of spending, which when government spends more than it has, it injects more new money into the economy. Government hires contractors get more cash. They pay their employees go buy. So then other parts of the private economy get some of that cash. So then a cycle of activity starts, a cycle of stimulus begins. So this is how they're planning to stimulate. But the problem is this has limits. If you want to do this too much, you will end up hitting the capacity of the economy to grow with liquidity, and then anything beyond that will turn into inflation. So there's just so much more productive your economy can become if you throw cash at it. Beyond that point, it just becomes an inflationary economy. So if that happens, you really, really want to own Bitcoin, which it will happen. And a few other things we mention is that we will be updating our playbook. Again, because most of the ideas we had here panned out, there was only one thing we didn't get correct, which was that we expected the recovery to not happen so soon. It happened actually even way faster than we thought. A lot of people were thinking recession. We said, V-shaped recovery, but it's faster than we thought. So a few weeks ago, we talked about this divergence from our expectations, and we said we are probably going to see a chop because a lot of the positive fundamentals have not still happened for us to sustainably go higher. And then we actually did get a lot of choppy price action. And Wizard, when he was discussing on-chain data, he was consistently mentioning that there is a lot of reasons to expect profit taking to go higher and so on. So we have to also, from an on-chain perspective, expect some level of choppy price action. So this view has to be updated, and we are working on an update for that to include a bunch of new ideas that are going to happen in future. The last couple of things I'll mention is, one of them is we covered Doge. The other one is the disinflation trend. Like, we've been also very clear since beginning of the year that there will be an initial inflation followed by a real sustained disinflation. And in the last report on Monday, we mentioned that when you look at the CPI data, it's probably our prior report. When you look at the PCE data, it's very clear that inflation is going down. As you can see, this is the PCE numbers. And the recent PCE prints were pretty much close to 0 annualized. And then the last one, 1.2% annualized. So it's dropping below 2%. If this continues year over year, will also drop below 2%. And inflation, especially in the Fed's view, will be tamed. We just got CPI data today, and they've confirmed the same trend. Inflation is going down. Month over month, we printed at 0.08%. So basically, so 0.008%, 8 basis points, which is annualized slightly below 1%. So definitely the economy is moving towards disinflation. When you look at goods specifically, goods have become deflationary. Goods prices actually dropped this month in May, and services inflation is really going down. Rent has gone down. Energy has become deflationary. Energy inflation actually has become negative. So all these trends are actually showing that we have a broad-based reduction of prices. And if that happens, the Fed will have less and less cover for keeping the rates high. And that will just add a few of these green boxes to our framework. If we win the fight against inflation, we will have rate cuts coming in. We have the tax cuts already in progress. We have cheaper energy. We have deregulation. The last point I'll mention is deregulation. In today's report, we had a very important commentary from Renault's writing. This is very important because Renault has been very, very deep into monetary mechanics, and he's been saying that the way Bessent talks about deregulation is he's focused a lot on SLR. SLR is one of the many limits that are placed on banks after the 2008 crisis. So they can't lever up. They can't really extend more risky, extend a lot of credit or invest in risky assets, just because the regulators really wanted to rein in on credit. And the slowdown of credit actually hurt the economy a lot. And up to today, we are still struggling with the limits, with excessive limits that are placed on banks, right? So one of them is SLR, one supplementary leverage ratio, and there are many other ones, right? But the important thing is, for the first time, we are hearing regulators talking about it's not just SLR that needs adjustment. It's many other limits that have to be lifted. So now we are getting more and more recognition that there has to be a holistic attempt to deregulate bank. Again, if you looked at Renault's writing, he's been very consistent that just removing SLR, even though it's fantastic, it's not going to give us the powerful deregulation that we need in the banking sector in this box. But he's very excited about the idea that now the discussion is expanding beyond SLR and many more limits that are placed on banks. So this is all going great. And I think one of the reasons for this is we have a Treasury Secretary that has actually been in the market, hedge fund manager, and knows exactly where the bottlenecks are. We talked about this, all these in detail. If you're interested, definitely read the big, beautiful report published on Monday. Okay, so that wraps up our quick review of this report. Next, I'll hand it over to Z to cover the on-chain section. For this one, again, the write-up is coming today. So the moment you get the write-up, the video will also be a